The Southern Company is one of the best known dividend stocks. It has a very good dividend yield while also compounding very nicely. It is in regulated utilities, so the volatility is not as high. Let's look at the numbers. Does it make sense to buy the company currently at this stock price? They highlight how much they're growing the dividend and how safe the dividend is because 90% of earnings are from state-regulated utilities. These produce very regular cash flow with very low risk, but they also provide not as much growth. They hope to grow EPS by around 5 to 7% per year by spending a lot of money. We can see they're planning to invest around $10 to $9 billion each year for the next 5 years. Now, do they have that cash flow? We can see their operating cash flow has mostly flatlined since 2014. So this increase in capital expenditures to even the high level before, they just don't have that money. We can see since 2015, the company has not made any free cash flow. They have been burning cash every quarter. And this is also reflected in their debt situation. They have been taking on a lot of debt. Not only are they investing a lot in their projects, but they're still paying out those 3 billion yearly dividends. This dividend has to be supported via debt. That is something I don't like. The company might make sense to buy still, and maybe overall you're gonna be able to get a good return, but paying out a dividend just by taking on debt is not something I like. So to achieve the 6% growth rate which they have to invest a lot of money. If they were to wind down capital expenditures, how much free cash flow would they produce afterwards? Of the 48 billion that they're gonna invest over the next 5 years, 15 billion is for maintenance, so that cannot be cut. If you cut maintenance by too much, you're gonna have another Pacific Gas and Electric. Now the growth could obviously be cut, but if they don't invest in growth, no earnings per share growth, resilience. Let's say afterwards they don't have to invest anymore because they upgraded their grid. Plus, the new infrastructure is going to be built more resilient than before, so you're not going to have to upgrade those. Let's say they're going to be able to cut compliance completely. There would be 16 billion, that's around 3 billion per year that they're going to be able to cut in capital expenditures. Currently they're spending 9 billion. It's projected to be a bit higher, but let's just go off that. Let's say they're gonna cut those 3 billion, that's gonna leave them with 6 billion of capital expenditures. Operating cash flow of 7.5 billion. It has sadly not really grown despite the huge investments, but let's just say it shoots up to 9 billion because of the huge investments they're making. Very unlikely, but we want to give a company a good chance. That will leave them with 3 billion in free cash flow per year. Their market cap is 80 billion. That is not a good multiple. Plus, this company is diluting you a lot. This is an electricity company. You're getting diluted by around 2% per year. Plus, there's still the heavy debt load they have right now. And it's gonna continue to grow because they're paying out the dividend without cutting back the growth spending. Even if I were to cut the capital expenditures by 3 billion today and operating cash flow goes up to 9 billion, those 3 billion would still not be enough to pay out the dividend. Not talking about any deleveraging going on. It is a regulated utilities company, so it's not gonna go bankrupt or anything like that. But so far, the investments that they have done have not resulted in growing operating cash flow. Plus, to achieve a good growth rate, they have to go heavily into debt. Interest expenses are already at $2.4 billion, and they just keep on rising. Interest expenses are now 10% of revenue. And I think if your interest expense is 10% of revenue, that is risky, even if your cash flow is as stable as this company. If we assume their operating cash flow shoots up to 9 billion, which is very unlikely, plus they spend the around 9.5 billion per year in capital expenditures under their current plan, that is around 500 million they're gonna have to take on in debt, plus paying out this nice dividend. $3.5 billion per year. That's another $17.5 billion. Now we're gonna still run the numbers, see what I would pay for the company. For the next 5 years, they're basically not gonna generate free cash flow. They're just investing way too much. Even if our operating cash flow shoots up immediately, they won't make any money. Let's say afterwards they're gonna cut that growth spending and some other spending we mentioned. While I was fairly optimistic, I think, with the cutting, let's say after the cutting and the growth that has happened because of investments, if they're gonna be able to generate growth this time, high growth rates at least, they're gonna have $3.5 billion in free cash flow per year. Now, they currently pay around 3 billion in dividends. Let's just say they won't increase that much because they will have to pay down debt. They just have to deleverage once this investment phase is over. It's just natural. Let's say after they stopped investing as much, they're gonna grow the free cash flow at 5%. They haven't been able to do this before. Maybe they're gonna be able to do it this time. 13 multiple, it's a utilities company. Not gonna be fast growing, but it is fairly safe. That would give them a market cap of $50 billion. The market cap is around 80 billion today. Not a buy. Now, what if it goes better? 7% growth rate and a 15 multiple. Well, in this case, $53 billion. Still not a buy. What if it goes poor? It's gonna continue like before. No growth. 2% for the next 5 years, and a 10 multiple because it's a utilities company that's very slow growing with a lot of debt. Then we're gonna only land at $45 billion. Southern is a company that is way too hugely leveraged, but at the same time they're paying out huge amounts in dividend that they cannot afford. The debt amount is growing, and it will for the next 5 years at least, and I'm gonna believe even at that. I think all of these assumptions are fairly optimistic. I know a lot of people own it because of a dividend, but the dividend is paid with debt. They haven't had free cash flow since 2015. They made $1 billion there. And even in 2015, they paid out more in dividends. I do not like companies like these. It's gonna be fairly reliable. I'm not gonna say it's gonna go bankrupt, but I don't think it will provide great returns. What do you think about it? Write it down below. Have a good day.